All right, so hi guys, welcome to another lecture. This is lesson 11 now, I think. So we've come quite a long way from when we first started the lecture series. Good to have you guys here. If you are completely new to the lecture series and this is the first lecture that you are stumbling upon, then I would implore you to go back and review the lectures from lesson 1. It's really important that you do that, because if you don't, in my opinion, I think you're just denying yourself an opportunity to learn something that you otherwise don't know. So I would definitely say go back to the prior lectures, go through them step by step from lesson 1 to where we are now. It will help you understand better and you'll be able to see exactly what it is we do here and how that's going to dramatically change the way you trade. It's going to change your trading results. If you're unprofitable, the one thing I can say, if you've been following everything I've been doing here from lesson 1 to now, you are going to be profitable. That is, for me, that's not a subject of debate. I know you'll be profitable because I trade for a living. I don't do anything else. So this is how I survive. And if I can survive, so can you, right? So at the end of the day, it's not, for me, it's never up to debate. It's just whether you're willing to put in the time in order to learn this so you can go on and better your own life and your family's life and the people around you that you care about. Long and short of it, go back, start the lectures from the beginning, do yourself a massive favor. Awesome stuff. Now, on to the meat of things. Last lecture, we spoke a lot about the cycles. So when we're working with weekly profiles, how we deliver price from those areas of very high liquidity back to the opposite side of the fence with areas again of high liquidity just on the opposite side. So in other words, how we run those buy stops or hidden liquidity, as I like to call it, back to running those sell stops, hidden liquidity, and back again to running those buy stops. That's kind of all the market does. Markets can't function without liquidity, and larger players need a lot of it, and often they can't get it without generating interest. And once they've generated that interest, they bring about all that hidden liquidity. Right? As traders put in positions, they need to put in stop losses. Some people need to put in pending orders that will bring them into the trade. All of these are market orders that will eventually be executed by your broker as per instruction. Right? And that's how it works. So that liquidity is not known to the market until those price levels are achieved. And that is why we get price delivery the way we do in markets. In the last lecture, I did promise to provide you guys with a video which essentially detailed how you would simulate a real market, right? So how would you build a market? If you had an opportunity to build a market, what parameters would you put in place? What would the entities need to be, how many of them, for that market to be liquid enough for everyone to trade? And it's already been done. And I posted a link to that video where a quant has actually built a market from scratch, and it runs and it looks just like any other market. So the pricing mechanism is almost always the same. You've got a few makers and then you've got a hell of a lot of takers placing trades randomly. That's the bottom line. And if that's going on, there will be a lot of makers who are going to create algorithms that deliver price in a specific way so that they can capture all those random orders that take us place, right? And it should look like when that pricing mechanism comes into action, or let's say that algorithm, it should look like the markets we see today. And that's why all markets are the same. It doesn't matter if you're trading crude oil, it doesn't matter if you're trading cable, it doesn't matter if you're trading the NASDAQ, the S&P. Some markets may deliver their price smoothly than others, but by and large, all markets will do the same thing, which means that what I'm teaching you here today with market profile can be applied to any market. It doesn't matter what market that is. And I'm going to demonstrate that consistently through this lecture series. All right, so let's go over again. We've talked about liquidity, volume, time, right? Which is my trifecta. Those are the most important things in trading. Where are the orders? Liquidity. What time are we taking the trade? Is there any volume backing that trade up? So in other words, are we going to run into any areas where it's possible that people are going to layer it with passive orders, or orders that essentially you can see? Those orders are in the limit book. You can see them, you know they're there, and they could be possibly orders that traders want to have filled. The reason why today we don't trust the limit order book is because their algorithms continually pulling and stacking orders into that book, right? And that's why we don't trust it. And when I say pulling, so they'll put a buy limit and then they'll take the buy limit away. And they'll put it back again and they'll take it away. And they'll put it into another price level and take it away. I think that's reminiscent of how traders behave in the first place. You might try to put a pending order at a support level, market behaves a certain way, you cancel it. And then you put it at another level. And then you cancel it again. And then you put it at another level. And then you cancel it again. So there's this repeated process of cancelling and placing orders in and out of the limit order book. And that is the reason why a lot of people don't trust it, because now we're not just seeing humans cancelling orders, we're seeing machines doing it. And why machines do it for a reason. So they're either trying to trick participants into believing something's going to take place, or they're trying to create a scenario where participants might be scared to take price in a specific direction. Then various techniques for this, everything from layering, as is commonly done in order to trick participants. You've got quote stuffing. So some of these things are illegal as well, depending on the market you're in. But the bottom line is that algorithms are essentially going to play a major role in modern markets, right? And that's why we don't trust the limit order book. Right. And of course, we do know that stop orders are technically market orders, so those are hidden to the market. Right. So we know we want to show an interest in liquidity, we want to show an interest in volume, and we want to show an interest in time. Volume, of course, we know why that's important. Like I've just described, those are passive orders that are going to be in the limit order book. You know why liquidity is important, because those are going to be what the bigger players are going to need if they're going to be able to move the market, or they're going to be able to get out of their trades. And those are going to come in the form of hidden orders, which will be stop orders. And that's why we get a run on stops. We also know that when we place the trades are important, because for example, if we place a trade in the NASDAQ session, then we're likely to get a lot more directional movement, a lot more volatility. Right? If we place a trade in the Asia session, we might get less depending on the asset class. If we place a trade, if we're stock traders and we place a trade mid-session, let's say lunchtime, we know we're not going to get a lot of movement. It's going to be choppy. And so time is a huge factor. Also, we do know that the bigger players often trade at specific times. Well, that makes sense. If you're a pit trader and you're used to trading in a pit and you've got $20 million in capital to trade with, then you're unlikely to be trading in Asia. Let's say you live in the United States, you live in Chicago. I mean, what are the chances you're going to turn up to trade Asia? You're most likely going to trade in the regular trading hours session, which is reminiscent of the United States. If you live in New York, you're probably going to target New York. And depending on the asset class, certain times are relevant. We know that the futures market is a lot more relevant after the NASDAQ open, which is roughly about 3 p.m. in London, right? So the NASDAQ opens about 9:30, and then so roughly about 10 o'clock, you're going to get a lot of futures activity, right? A lot of more experienced traders prefer to trade from 10 o'clock onwards, especially in the equity markets, or, for layman terms, the stock market. So there are a lot of reasons, lots and lots of reasons why time is a crucial measure, right? We also know that certain volatility items, like certain data points, come out around about sort of 1:30 UK time, which in the United States is roughly, depending on daylight saving, it will be 12:30. It'd be about 8:30, or 9 a.m. Right? So when we start to think about these points in time where things happen, you're going to find that these times are going to be relevant to what you're doing. Right? So I have a trifecta. It's called liquidity, volume, and time. All our trade metrics need to conform to that. So we shouldn't be taking trades on lunchtime unless we really can't help it. We shouldn't be taking trades in areas where there is no interest, right? There's no liquidity there. There's nothing going to go on there. We expect the prices to deliver to a different level. We should not be taking trades, for example, that are not supported by any kind of volume information, right? We don't know what's essentially we don't know what's going to happen, or we can't even deduce what's going to happen. Right? So there's a lot of reasons why the trifecta is important. So let's start again by demonstrating some of these reasons and go through some of these different asset classes, and then hopefully we can discuss a few more concepts surrounding market profile that you would need to take into account as someone who's trading with a profile. Again, if you haven't seen the previous lectures, please do, because I've covered a lot of basics in there, and now I'm more concerned about covering what's going on the right side of the chart. Okay, so you can see blow by blow, lecture by lecture, what we're thinking and where we think the market's going to go. Okay, so we've spoken about this in previous lectures. So we had a draw on liquidity, and that was very easy to spot, so we can see that level here. And this is a daily profile, right? So effectively each profile is 1 day, and we're drawing on the stops at the highs. Now, and then we closed lower back in. Now, what did I say to you guys? I said, well, once we've done that, my expectation is we're going to start to deliver to the next area of interest, which is likely to be the bid stack at 34.31, and more than likely we can deliver as low as 132.40s, right? So this sort of region, 132.50s, and even better, we can deliver as low as here, where we can draw on sell stops. But for now, we've done a run on the buy stops, and we're trading lower. So first stop is going to be backed by volume. So that's our second trifecta in, right? And that's where we're looking for a reaction. So if we're short against the day, for example, so let's say we're longer term traders in this point, and we want to get short, and we're using the entire daily profile as a reference. So we moved up a little bit to the highs, right? So you can see initially we pulled in. You might have wanted to get short on the open and said, well, I'm going to sell here, and I'm going to put my stop up here. Understandable, right? And that means that my target is going to be down back to the bid stack, right? And that's what I'm aiming for. Well, that's likely to be 5-6 days maybe worth of price action. We don't know, right? That's pretty hard to tell how much time it's going to take to get to a place. There's some, ways of deducing that to an extent, but I'm essentially saying we've got approximately, 5 to 6 days before we're going to touch out this kind of low. That's the expectation. We can clearly see that that's fueled by the fact that we know on a daily frame we've had a run on stops. And that makes sense because now from an execution standpoint, we wanted to be short and we want to go low, right? Now in my last lectures, I did show you some of the trades that I did associated with this very idea, right? And I showed you all the trades I did across the days. I think we had about 5 trades. Only one went wrong for us, and I showed you how we went about executing those trades on this asset class. I'm not going to go back to that. If you want to see those, just go to the previous lecture, and that will give you some more context. Yeah. And at some future point, I'll come back and I'll show you more trade examples. Again, just so you know that this is something you can do consistently, right? It's not a one-trick pony, right? This is just how the market makes itself. And as long as you're familiar with it, and you've got good risk management, which we will talk about in upcoming lectures, then realistically, you shouldn't have an issue, right? Again, you start to experience problems when you start to ignore a lot of what I'm trying to tell you. Right, so this is how we're positioned, right, going forward. So now let's take a bit of a back reverse. Let's go back. Let's reverse a little bit, and we're going to split the profiles so there's a lot more clarity, so you can start to understand how we execute again. For those of you who haven't been following too well on previous lectures, again, I'm just going to open this up here so you can see exactly what's going on. So here you can see in Q period on this day, we drew on the liquidity, and Q period is like 2 p.m. So it's the NASDAQ, so very time relevant, right? So we know that there was a lot of active interested parties at that level. So it made sense once we'd seen the draw that, and we'd come back in, and where we're looking for us to come back into, if we go back, right? So if we close this profile for a minute, and we look at where we are on the longer term, we can see that we drew on buy stops that were sitting above this level. And what that means is that as soon as we came back under that, roughly in our period, we wanted to have a short position, right? And I actually showed you that M position in my last lecture, right? And then stops obviously can stay at a higher than NASDAQ. Naturally, we all have to put stops in, so that's going to be liquidity, but we're hoping that this initial draw has given the larger entity enough of the buy stops that it needs in order to move this market lower, right? So it's gone up, it's done a run on buy stops, right? So those people who are short have asked that they want their positions to be bought back. So in other words, they want to, get out of the trade. That's going to be done with a buy stop order, right? And once that position is bought, essentially they've sold to someone else. Now that should make sense. So that gives the larger entity an opportunity to get short, right? And that's just how it works, right? So what they've preyed upon is traders who are short, who are intended at the very least in a lot of cases to be short, but put their buy stops at these levels. And that's allowed those stops to be hunted, and then the market continues going back in the other direction. So you'd want to put a stop here, and where would you look to get out of that trade? Most likely in the European session at some point. That could be at the lows here, and because there was a bid stack here for sure. Or you could wait for the following US session to open, the NASDAQ, and then cover that trade. So you'd have a bit of an overnight trade, but you'd be able to get out on the NASDAQ. Right, and that's exactly what happened. Again, if we split this profile, if we look at what went on here, we can clearly see that on the prior day, US NASDAQ open, pre-NASDAQ, we had a big flush in P period, and there'll be likely a lot of stops under here as well, right? So there'll be a lot of hidden liquidity sitting at that level. We can see in the NASDAQ, we pulled on that, we settled, again, another perfect opportunity to get long. Once we pulled up, we did a new high against the NASDAQ highs, we settled, and then we consolidated. For me, that's a really good trade to take into Europe, right? Maybe not so much into the US session today, but definitely into Europe. That would have been a really good long. I did not take this trade, right? I spoke about the potential for it to happen, but I did not take the trade in the end, right? Opted to do something else that was a little bit more, what I felt would offer up a bit more of a reward. And the reason I didn't take the trade long is because I was expecting us to sell off again based on the fact that we'd drawn on the liquidity on the daily profile, which means we should go much lower on a day-to-day basis. So the rally would just be a rally. And if anything, I would need to short that. So if you wanted to take that long, presumably you'll take that long into the close of Europe, which would have been roughly about here, or getting closer to the close of Europe. And that's where you want to exit the trade. So there wasn't a lot of risk reward per se in it for me if I was going to trade this on an intraday basis. So it didn't make sense for me to go into that trade. However, we've come in, we've opened the NASDAQ, and we've drawn on short-term liquidity, which is between D&E period in Asia, but I'm expecting us to go much lower and take out the Asia low, and we might draw on the liquidity just below the NASDAQ from the prior day if we're going to keep rallying. But since my expectation is that we're going to break down, this area is not really an area anymore of relevance to me. We've seen it. We've seen a draw on stops here. We know we got some below I period. We've got some here. So we're probably going to get a draw here too. Maybe a small rally and then a continuation. So I'm more focused on seeing what opportunities we could have on the short side. Now, if you wanted to short this, you would be looking at this profile here. Now, we've seen us rally out of and cross over what looks like a mini bid stack and go higher. But what have we seen the market also do? We've run into the offer stack here. And if we condense this, you can see we had a much bigger offer stack here, right? So that's volume supporting that. And then we go up in M period and we trade against, right? So if you look at F period where we had that drop, we draw against stops. So we take out the buy stops in L and M, and then we come back in N, right? So for me, this would be a better trade to take, right? Since we are directionally short, you can go short in N period with essentially stops above M or M period high. Safety net, a good safety net would be M. And hopefully this market stays and we take out the Q period low, right? Which is what we're looking to see if that were to happen in this NASDAQ Chicago session. If it does, then ultimately we're going to look potentially at a cascade coming into tomorrow, right? So that market should look a lot like trading to the low, which is about 34.48, right? And that's where we're going to find the next set of volume, which is the bid stack. And that's effectively what we're aiming for, right? So if we put that here, right, it's a bit of a wide bid stack. And then we pull that down here, right? So that's what we'll be aiming for. So if you're short here, you're looking to get out somewhere between, usually just as we're tailing into the bid stack, right? It's going to be a little bit above, some way within, but we should hopefully see a reaction there, and that gives you a good opportunity to cover your trade, right? So this would have been a good trade short. Now, if we can pull back in, so let's say in Chicago we rally and we hit the M period and then we struggle, that also becomes a pretty good short since we have a short bias. And we have a short bias because if we close this current profile, let's delete some of this since we now understand the concept. We have a short bias because you can see us go up and hit the offer stack and get rejected, right? And the way this daily profile is shaped up, we're pretty much getting close to the end of the day, right? So there's not a lot for this market to do. Now we could potentially open tomorrow and do a value trade to the upside, right? And that could essentially see us draw in on this liquidity here, very possible. But typically when we see this kind of setup, I would position myself to be on the short side. Now, if I'm wrong, then I'm just wrong. That's not a problem. I know that at some point we're going to come back and attract more sellers if we try and get up back into these highs, right? And that means that we're going to look at maybe drawing some liquidity above the Q period high. If we look at the weekly profile on cable, it gives us the same thing. What did I say? I said that on the week, we've drawn on the liquidity above the weekly highs, right? And you can see that settle here, and then we've gone up and retested that, and we're coming back the other way. If we take the low of the week, then that opens up a hell of a lot of downside to 134.40s. And that would be consistent with a range on the week. We expect typically from top to bottom in any given week, we're looking at approximately, if you measure that out, you can see on the panel, 178, 164, 282. So we could be around about 200 pips on the week. So top to bottom, if we look at that, 168, so 170 takes us to the low of the prior 2 weeks. If we do a value area, so we break the bid stack, then that puts us somewhere about 133.42. So that could be a pretty big drop that could just turn up out of nowhere against the week. We can see there's a lot of volume. If we trade under the low, we'll be under the volume. So that's also going to increase the likelihood that we're going to take out the bid stack here and here. This is a hell of a lot of volume supported by a responsive seller. What do we mean by a responsive seller? I covered this in the previous lectures. In the link in the description, I've got a link to free lectures on market profile and Udemy lectures on market profile, which are all easily accessible, which will give you the very, very basics that you need to know market profile. This lecture does cover the basics, but that one covers the basics in depth. So if you wanted to see that, you can go and click on the link in the description and you'll have access to that. Not a problem. So here we can see that W print, right? That's a responsive seller. So we know that we've gone up. Responsive seller, lot of distribution is what that looks like. Could be accumulation, but judging by the behavior and the draw on weekly stops, I would say that we're positioned to go lower. We've retested the highs again and we fell. So if you split the profile, the way we're setting up, I'm making the assumption that E period is no longer going to take out the D period high. If anything, we might get a draw on short-term liquidity against the week, right? So that's all we're likely to see. My expectation is that we might continue lower, but let's see. We're trading against the weekly balance at the moment, and then we're bouncing. But for me, the key level to watch would be a trade below the weekly low. That is less likely to bring a run against buy stops. There might be a small dink, or say a run against sell stops. There might be a few small dink, but by and large, we will end up going much lower. So these are some of the nuances you can build in. You can see that through other sessions, that as soon as we take out the balance low, we tend to go strongly in one direction or the other. So the weekly balance is pretty strong, and if we're trading either side of it, we're going to give range extension both sides. Often range extension on one side tends to overweight range extension on the other. So here we have short range extension, huge range extension, short range extension, huge. So it's never an equal distribution, or we get a directional move from the range and then a fail at a later stage, or continuation, but we don't tend to get equal distance. So if we fail here and we come under the range, well, judging by what we can see, and this is some of the deductions you can make, it should essentially tell us that we are potentially gonna do a bigger range to the downside, and it's highly probable, right? Trading is a probabilistic game. So if I can see the probability that something's going to occur is very, very high, then that becomes an area of interest, right? And we'll talk a lot about probability in future lectures. So we can put some price levels at the back of our mind. 135.10 would essentially take us now outside the prior value for the week. So we'll be trading a degree of excess against the prior week. And we can also easily tell that a range extension will put us at 134.43, maybe some reaction to the bid stack. But again, we'll have to see what that looks like closer to the end of the week, right? It's just what it is. I mean, this is like the first period's developing this week. So it's very early days. We're just at Monday. So we've got Tuesday, Wednesday, Thursday. So if we're down here, say for example, by Wednesday, then we can start to anticipate that we're going to get a strong Thursday and Friday that might extend us through the range. So we've got a few areas of key interest, right? We've got volume for second trifecta. We've seen a draw on liquidity, first trifecta, which is giving us a bias short. And we know that the market will seek these stacks because they're likely to be passive orders there. So that's also telling us that we're going to be bearish to the stack. So we're going to head towards it. We can see a balance break will reinforce that, because what that will tell you is that the initial balance is gone and we're likely to overextend on one direction. So again, that will fuel the bearish bias. So if people were not very confident to get short at 135 handle, they're going to be a little bit more confident to get on the short side. We've seen a fail already, and so we've tried to push higher, but we failed and we're coming back. So we're at the point where we have to start digesting reality that this market might not do the upside anymore. Now, never say never, but for me, everything's set up in a way that's saying we could end up being a lot lower than we are currently. Point in case. So that's cable, right? And all markets behave the same generally. So we've managed to blend bias taken from a weekly profile with a lot of information there to indicate that our short bias is correct. And we've also drawn on information from a daily profile to indicate that, again, that short bias could end up being correct. There's other ways you can assess potentially direction, and that's from using level 1 volume, and you can use a candlestick chart for this. But I've got the professional trader program, which is also on the channel. There's a separate playlist for it, which covers lectures which do a lot around candlesticks, and the last few lectures are to do with market profile, but it was quite a summary. This series is going to cover market profile in depth, which is what I use to trade, and it's what I use to plan everything that I do. It doesn't mean that you can't use a candlestick chart. I would advise that now that you know this will give you an edge. If you didn't know it before, I understand why you'd want to be stuck with candlesticks. But the fact that you know this essentially should give you a little bit more of an edge, right? Makes you a little bit more dynamic. So again, if you want access to the profile, join the Discord server. It's flashing on your screen right now. Just put that in your browser, come into the server, and then you can ask me DM going forward. What I'm going to do in the Discord is allow traders to be able to download it directly from there, and then you'd have to obviously still send me the MT4 to get activated. So you have to send me the MT4 number, and I'll activate the TPO for you. So you'll be able to use it with that specific MT4. If you want to use it with other ones, you have to give me the ones you want to use it with. So whether it's a demo, I don't care. Whether it's a live, whatever you want to use it on, you have to provide me that MT4 number, because that is the number that we're going to use to validate the tool for that particular MT4. It cannot be used randomly on just different MT4s. So you can't get one license for this and then basically put it on 20 MT4s. Unfortunately, you can't do that. Right, so this is not something that I'm giving you away for free to go distribute everywhere, on forums and stuff like that. No, that's not what's happening, right? This is for you. This is so you can turn your life around, and the people who choose to come to this channel to learn this can turn their lives around. It's not for distributing on the wider internet with people following all kinds of Dick, Toms and Harry. This is not what this is about. All right. Going forward, so we've developed our bias, and we now can use the daily profile to quantify that going forward in terms of decision making, right? So we can see that we're rallying. We did have some strong volume trade out in Q period. Let's see how R period turns out, right? And if we are going to get a rally, it would start from the R period, possibly taking out the Q period high, and then showing, in my opinion, a little bit more volume to stay the course, right? And then we could see a very small rally back to the upside. A lot of it will depend on where the volume is on these sessions, right? The Q and R from the prior session. And if you look at the tip volume down here, it's not in line, by the way. So it's not in line. You've got to kind of find the day, but I can easily do that here. So you can see that we had high volume in New York, followed by high volume in the Nasdaq. Right, so you can see that here. So the Nasdaq is still holding it. As soon as we start to bid under the Nasdaq low, I would expect that we're going to cascade. So let's see what happens, right? This could end up holding, and we could come to M period and draw liquidity, which is why this market hasn't looked very interesting to me. If anything, I would have been short it, but I don't have a position at this point in time, not in cable. If we take now a peek at some of the other assets, where we can see that we're seeing exactly the same thing. So this here is the Nasdaq. If I condense it a little bit, see everything a bit clearer, this is the Nasdaq. 30-minute rotations, because obviously we're dealing with equities, the Nasdaq opens at 230. What do I mean? 30-minute rotations, it means that each of these letters is 30 minutes as opposed to 1 hour, which it does seem with cable. And that's how we set it up. I'm also going to take the opportunity to show you how we can set our tool up, or what we need to do to get that operational depending on the asset we're looking at. Now, obviously, this is my own version of it. This is my own licensed version. It's not going to be retailed out, but essentially yours will look a little bit different when you do get it installed. And different, it means that there's going to be another variable in here, which is going to be your password variable. So when I supply you a password, you're going to put that into the password variable, and that will activate your individual MT4. So I've got 42 profile look back, which is what I want to see. So that's about 2 months worth of trading days. Daily profile, 30-minute rotations. Start time is midnight, and row size is 15. Because the Nasdaq has 5 digits, essentially what I'm doing is referencing the last 4, right? So this is really technically 15 points on the Nasdaq, right? So that's the row size on pips. And then we move lower, and I say 15 handles. Let me just check that actually. Because I'm so used to just setting it up, I'm gonna just measure this as well. And how you measure the row size, it's really simple. it's from the bottom of the row to the top of the row, and as you can see, it's about 15. Not 100%, I'm trying to get it as lined up as I can, from one row size to the next, and as soon as we get the next row print, that will be a complete row. So it's about 15, it's about here, right? So if you look at where the cursor is, we're going from about 839 to 853, right? So it's about 15 handles. Right, so it's a filtered profile. I've kept it 15 handles because that's more relevant for a letter than say one handle or two handles, right? I know some people will trade that way, very small handles, but for me, especially when you're using CFDs, you want to get a big enough filter there because these have spreads, right? So unlike the futures that don't, these have spreads, so you want to watch those handles pretty closely. So 15 handles is good enough for me for a letter. It gives me a lot of directional understanding. Moving on. The balance, of course, that's the first half hour of the midnight open. For me, that's the balance. You can set that differently. So you can set your balance to maybe New York Open, NASDAQ Open, what suits your preference. Right, so this is how you're going to get it set up. And then you just click OK and you're good to go in this case. And we're live, right? So that's it. And your profile will reset, and then you can stretch it via the scale, adjust it to your liking, whether you want to condense it a little bit, spread it out, whatever takes your fancy, right? Now it only responds, so it only give you markings to the y-axis of the scale. The x-axis is totally irrelevant to what's going on here. If you want to see what day you are, you just click on the individual profile and it will give you that here. 5th of June 2025, 6th of June, 9th of June. Not complicated, right? So hopefully you guys have a bit of a snippet how to use it. So let's look at the NASDAQ, right? And let's see how the NASDAQ has delivered over the past 1, 2, 3, 4 days. So I like to stay on the right side of the chart. I am not going to go back to the left side of the chart unless there was something relevant there, right? So we're going to stay as close to the right side of the chart so we can start to think about what's happening currently and where things are going. So if you look at how the NASDAQ has been delivering in the last couple of days, you can easily split the rotations. That's the first thing you want to do, and that's going to give you some context, right? Now, what did we see with the NASDAQ? So we know that there are going to be stops under these extreme lows, right? So let's just take the O period low, right? We know we're going to find sell stops here. We know the next level for sell stops is going to be under the S and U period low. So that's about, on this day, that would have been a 2-day look back. And then we have a bid stack sitting at this level, right? So we can tighten that up a little bit. No, I could tighten it up too far. So we can tighten it up a little bit. And we expect that, if anything, the market will draw a significant reaction into the bid stack. But for now, we're going to focus on the liquidity at the base here. So we come in at Q period. This was end of day, 10 o'clock. This is about 8 in the evening. We come in and we draw after hours on liquidity, and then we start to run up. The moment that we settled in M period, this becomes where we're looking for a long play, and we can look at getting the stops a little bit tight, either under the lows or maybe under the significant trading that we can see on this profile, FGH, IJK. We can sit that because our expectation is if we pull back into this price area, right, this one here where the stops would have been, that's where the market is going to find support. We shouldn't really go too much further underneath it because then that would lead to another draw on stops. And in which case it could mean that we're going for the low of day to draw liquidity from that. But we've already seen 2 draws, one on short-term liquidity and one on long-term liquidity. So I would be fairly confident placing a long. Now, if I lock this profile in, so let's do that, highlight it, unsplit, you can clearly see that once we ran through and through value and settled, we are setting up to be bullish, right? And we can see all that internal behavior. And if we condense all these profiles, we can clearly see that we drew on sell stops at the low of the prior day. And then we've rallied strongly. What's that telling you? And now we're building volume at the base and breaking upwards. So that's telling me that we're going to do new highs on the NASDAQ, because the next place we're probably going to end up is drawing on the liquidities at a high. Now we had an initial draw on the longer term liquidity, came down, but that was soon fueled by a draw on the shorter term liquidity, and we're back up again. So that's immediately telling you that the NASDAQ is pretty strong, and we're probably going to start to do a run on the highs here. Judging by the range of the NASDAQ, if we do not fail, then we're going to do massive new highs. Right? That's going to put us somewhere about 22,078 and 78 on the index. It's not complicated. It is 100% not complicated. That was a very easy deduction. So can I get in this trade now? Well, no, I can't, because we're now coming into high of prior day. So if we find liquidity there, we're going to draw on buy stops, maybe even come down and draw again on sell stops at the F period low. That's going to be no good to you as a trader. I don't think so. I think rather than draw on liquidity here, we're likely to draw on liquidity there. And that's because of the nature of indices in general. And I think that from there, you have to start looking to see if the market responds to a sell, right? So we just get an additional draw. So we've drawn this long term. Are we going to draw this long term, right? We've already seen, we're seeing a rotation. So we're rotating out G period. And what does that mean? It means that we're printing out any kind of competitive selling. So each letter has now got a partner, and that means that we're probably going to do a new high already, right? So we should see another H print, and that should continue. So we're not acting like we're drawing on stops at the moment. What it looks like is that we're potentially going to chase the high of the 2-day high. So that's a really easy thing to deduce. All the markets do the same thing, right? And the good thing about the profile is that you can look at, I'm going to delete all of this, you can look at the longer term liquidity and you can compare that to the shorter term liquidity. So you can do everything in one frame. Notice that I haven't had to come out of the daily profile in order to do this. Again, if we look at this here, we can clearly see without even condensing the profile, we had a draw on sell stops here, closed higher. And you can see that because you can see the reaction in L and M. What stops you getting long here to go for the highs of day. And then we go up. And from there, we know that if we condense it, that we've had a major draw on liquidity on the short term, but that's also now carrying into the long term because we can see the shape of this profile. We had a nice little stack up here. And as soon as we broke that, we start to understand that we're going to deliver for the highs, right? Because now this is these are daily profiles delivering against the longer term to the high, because we saw this draw on this liquidity at this huge bar here. Again, you can see another example of that on this side, where we come down and draw on the liquidity here, and we can see that reaction. And again, you're thinking the next stop will be here, judging by the daily profile close. So if we think about this for a second, all we're doing is searching for where there's hidden liquidity initially, or we're responding to where there's passive orders sitting that need to be filled. So those limit orders, and those can be seen in the form of stacks, or we can see the hidden liquidity in the form of lows and highs on different frames. What makes it hard for traders to digest is the fact that they have to keep swapping frames. And it's mental. Like, I used to find the same. If you're trading on a candlestick and you're looking for this information, you have to keep going from a 1 hour to a 5 minute. So you have to kind of build these steps, right? And sometimes it can be too much for the human brain to process. I'd rather see something like this, right? I can see that these are daily lows. And I can see that we came under, we drew on the liquidity on the day, and we closed up. So for me, I can see that we've closed up on a daily bar. So if it's a daily candlestick, this will be a daily candlestick. I can see we've closed up on the daily candlestick, but I can easily split this and see what we're doing on the intraday 30 minutes. So I've gone from 1 day to 30 minutes with a click of a button. That's an edge, right? It's something I can see and interpret really quickly. So I'm trading the daily time frame, but I'm also trading the 30-minute time frame at the same time. So I'm able to manage my risk very tightly alongside doing the daily. And the exciting thing is I can break this down to as small a window as I want. This, for example, was the Canadian dollar. These are 1 hour profiles broken into 5-minute rotations. So I've got a 5-minute chart here against the 1 hour. Again, you can see that quite plainly. You can see a draw on the sell stops on the 1 hour, a close up. I can take this trade in a 5-minute time frame and carry it through multiple hours, because I can see we've got a bid stack here. We've pulled back into that. We've closed initially above. So I'd get long as we drove into passive orders, right? So we got here and then we settled up in E. I can get long here in E period and then have my stops at the base or covering the entire length. Now, if I look at that, that's a 7 pip window, right? So that's 7 pips, top to the, or nearly 8 pips. And this market has moved 28 pips. That's a 4-to-1 on a risk reward basis on this trade. Now, what would I have been looking for, right? If I can see that we've had a big move on a 1 hour frame, these are 1 hour profiles, then I'm expecting us to deliver to the highs of the prior day. So if we look at that, that's the 6th of June, right? So if we highlight that, and then we come over here, that's the 9th of June. So this was Friday. I'm looking us to deliver to the highs of Friday, right? And if from there we can get a draw on liquidity, we can expand these profiles out a little bit, so we can have like maybe 30, 40, 50 profiles, so we can get more data context. But that would be what I'd be looking for, right? And if we split this now, we're delivering lower. So this would have been a classic opportunity here, because we can also see that there was a draw on very short-term liquidity against the hour, right? But we can also see that it looks like we're experiencing a draw here on longer-term liquidity, right? Just to confirm that, you need to add more profiles, but I'm not going to do that yet. But if I'm right, then we can easily start to deliver back down to the downside. So again, it doesn't matter the time frame you want to do, you can still put the profile to work. And I'm going to cover a lot of these short-term profiles in future lectures, where we're going to be able to sit and plan trades on shorter time frames, not just on longer time frames, right? Where you can get really good explosive moves that you would want to take advantage of on a short time frame. And let's double back to the agris, right? Because we talk a lot about these. So here's a good example, corn. Right, so this is corn. It looks no different from cable when you're looking at mental profile, and the behavior is going to be exactly the same. So again, I'm going to just stick with the right side of the chart. Let's collapse this for a little bit and collapse this. So corn's been quite volatile. We can see by the way the profiles have formed. So if we take 1, 2, 3, 4, 5 days, what's gone on? We split the profile. What's the first thing we notice? Let me delete this actually. And I'll just use these lines, is you can see that we had a slight draw on liquidity on day number 3. So this was the initial move. So, and then we're going to split these up a little bit. So we had 2 points of interest. So initially we set up the profile here. So that put in a low, sell stops below here. We put in a high intraday and we can see the high here, right? And then we can see at this point, this was the pre-market high. And then you can see that draw in Z period on short-term liquidity into the open at a pre-market high. And then we close lower for the run. Here you can see that run on the prior day regular trading hour high. You can see us go up there, draw on stops, come in on the market open. We're looking to get short anywhere between A and Z period, anywhere within this range, right? So we just want the best possible position. if we're short here, for example, so we broke lower, back in, let's say we've got short here, stops will go a little bit above the high. What we're looking for is for us to deliver price down to this low. We open that up. Let's reposition these just for clarity. And we can see that if we were short here, we're looking for us to get down to these lows. And that's what happened here. From here, what are we looking to do? Is as soon as we've got the recovery in B period, a few ticks lower, we want to get long, and then stops below the low. And where we're looking to drive, we're looking to drive back to the pre-market highs of this day or regular trading hour high, or back to the Z period high. And that's where we should see a draw, or even the F period high here. So we're going to see stops positioned here, here, and here. Based on the longer term direction, we're going to see a draw on liquidity at one of these levels, and it's going to be likely at the market open. So again, you can see that we moved higher very quickly, and then we cut back in H period. Once that happened, what are we looking for? Again, we dropped in, it was end of day, so you just want to wait for the pre-market. You don't want to take a position like end of day. You want to wait. Here we took the liquidity out here, closed up in end pre-market. If you saw this, you just go short in the pre-market and then put your stops on the high. And then hopefully come into the market open, you should be much lower, which is where we are. I still think we're going to drive, take out the liquidity here, most likely take out the B period liquidity where we want to get long. But we can easily wait and see what the market does coming into the open, right? So if we drive into these levels, that's what we're looking for, right? We've already got quite an extended move. So as soon as we can get into these price areas and recover, that becomes a good long. That's purely using the liquidity model here, right? So we're looking for where those pending orders are getting activated. And commodities, obviously, something like agri is a smoothly delivered market, specialist market. So there are not many players in there. Obviously, you won't trade this on MT4, but I've got a feed, which is great. You would need a platform like Interactive Brokers or some of the other futures platforms. If you're already in futures prop firm things or whatever, well, there you go. Right, you've got an asset class to trade, and I'm pretty sure you're going to do pretty well. Corn's a great asset class to trade. Right? So we can see that, and this is consistent through time. Even when we're breaking out, we're still going to reference lows historically, and we're going to get rallies out of those lows. So there's always going to be the market searching here and there for liquidity. So it's no different, no matter the asset class you're looking at. Okay, so I think we've covered a lot today. Right? So I'm going to bring this lecture to a close. On the next lecture, I'm going to try and dive in a little bit to structuring trades, money management, what that should typically look like. Because again, I think it gets really complicated when traders are not convicted and they don't know how to manage money. They don't know what they're looking for. So it's okay to lose trades, but you need an edge. You need that 50-50 edge at the very least in order for you to start seeing the potential to profit and make money. And personally, even when I look at my own stats, it's incredibly easy to do to achieve a 50-50 edge on any asset class. You just need to have a clear entry point that you always use consistently. Like, you can't vary your entry criteria too much because everything's based on occurrence. I showed you an example of a couple of trades in my couple of lectures. Out of 5 trades or 6 trades, can't quite recall anymore, only one we were out of kilter. Now, over a longer series of occurrences, that might narrow down to 50-50 or 60-40, whatever, right? But that little added discretion, of course, is going to mean that the edge should, if you're using the same entry criteria, the edge should remain consistent over time. And I think there is at least a 50-50 chance that if a market trades into sell stops or buy stops, it's going to reverse in a different direction. There's a 50-50 in this. I think we all can agree that this is not a situation where we're going to say that, no, that's only going to happen 20% of the time, because we can clearly see, if I just use corners as an example, and I'll just take the right side of the chart, 1, 2, 3, 4, 5, 7 days. I'm just going to take a week and let's analyze the right side of the chart. So I'm not going to go historically, because that's really easy to do, everything in hindsight. So the hindsight is going to stop with these days. I'm just taking this day into consideration. How many opportunities would we have had using the same metric, right? So it's not complicated, right? So I'm just going to stick with the right side of the chart. So what can we see? Easily identifiable stops above Q and Z. We know that. Split the rotation. What happens? We drive above Q and Z in the market open, A period. That's 230 when the agri's open. We sell off, clearly a draw on liquidity. So that's occurrence number one. We get a slight pullback, we get short, and we're looking to go to the low. Risk reward, this is 2 points, and we're looking to capture 6 points, right? That takes us to the low. In fact, we get a 10-point run. I'm not saying you're going to stay in the trade for 10 points. You might have gotten out exactly on 6 points, right? Still a 3-to-1. So we've done day number one, first trade, right? So we used the prior day as a reference. We put the trade on that day. We're now down to J period. Split the next day. Open, market continues lower in pre-market. What do we have? We have stops under J. We've run a hell of a lot of them by this point. As soon as we recover over J, we know that we've run all the stops. Right, so P period, strong price action. Looks like we're going to do it. R period, strong price action. S period, we're above. If we can trade back into, let's say, the S period low, right, since that's the close up, if we can fit ourselves anywhere within here, then that becomes a good buying opportunity. We get that even before the market open, right? Market opens a bit on a high, so we had a short-term draw on liquidity and then sell off down into X period. For me, that will be a clear sign that I wanted to be long against the dip, right? So now I'm going to put my stops. I'm always looking for about a 2-point stop, right? On average, right? So I'm going to put my stop somewhere around here or at the low of P period, which will be about 2 3/4 points. So we're not quite, we're a little over the 2 points, but that's not a big deal. I'm sure we can make this. Market runs eventually for 8 points. Again, that's like nearly a 4-to-1, right? So we were where we needed to be. So that's day number 2. Let's say that you even were a bit eager trigger on the figure, right? Trigger on the finger on the trigger, and you wanted to short this instead. Well, let's say you hit that level, you say, no, we're going short. The big move on X, and we're back. We looked at a pre-market high instead, right? We didn't account for the fact that there were stops under the J period, and that's what we're looking at. Okay, we're new to this, right? So we wanted to get short in a hole. Even at that, if you'd shorted on the pullback in Y, that would have been close to a 2-point stop, but we will set our limit orders so that we can capture at least 2 points about here, and then a drive lower. That was still a 3-point drive lower. It's still a 1-to-1. If you'd gone break even, you would have been tapped out. If you didn't, you'd have lost 2 points. Right? But I have a different experience. So I probably would have traded long as opposed to trading short. But if you did trade short, that would have been 1 trade lost. So that would be a second trade lost. Could have been won or lost, but let's say lost for argument's sake. That's 50-50. The next day, now that you know, you can see the Z period high. There's an offer stack here, so there's some volume backing you up. And then we start to go higher, right? Z period, we had a draw. What do you want to do? That's pre-market. So Z period would be here. Oh, there it is. So it's actually market open, Z period, we had a draw. What happens? Go short, hold, boom. We're going down for 6 points. So here we should get about 2 points of risk above the Z period high, down 6 points. In fact, this market went all the way down to 10 points, right? So that's another day. So now we already have a higher win rate and we're doing very well on risk reward. And finally, let's come to this day. Again, rise pre-market open, we go under the J period low. Once again, it didn't matter what direction you traded. So here was clear, we had a pre-market high here, we opened, we'd already started to see a stop running Y and Z. X is the higher day at that point, and then we open. And look at the cascade, right? So we opened about here, dropped all the way down. So let's say you didn't even catch the short at the open. You thought, no, it's fine, I'm gonna wait to see if I get the extremes. Well, you got that at the B period right here. And that would have been another rally. So you couldn't have lost money this day. You just couldn't. It was just definitely impossible for you to have lost, right? This was a total take out sell stops, take out buy stops, done and dusted. You could have been short here or long here. Didn't matter. Whatever you did today, on that day you made money. You're way into the 70% territory of profitability. Now, because we extend that out, it's clear that we're having more scenarios where we're selling off highs and reversing off sweeps on the low. You're going to get a 50-50 at least if you do this over a number of times. So what's going to stop you from doing this? Right? You've got a great tool like Market Profile to back you up. You've got all this information. What's stopping you from doing it? It didn't matter what you did. There's a higher chance that you are going to find yourself making much better trades. And it's going to be a 50-50. What you shouldn't be doing is taking matters into your own hands and saying, well, I'm going to trade now because this looks right. I'm into a bid stack. It's great. I'm going to go long. No. We can see that they're going to be sell stops here and they're going to be sell stops here. One of these, I want to see that market trigger. If I already had a short, then I'm done for the day. If I didn't have a short and I want to get long, then that might be tomorrow's trade. But today's trade was really obvious. You needed to be in a lot earlier though. That would have been at 8 a.m. in Europe, right? To catch all this move. If you're getting in the market in the NASDAQ open, then you got a lot to wait because the market's just open. We could still go lower yet, right? Or we could reverse. But either way, we're so far from where the liquidity is, I would rather wait and see if we can take out these lows. And in future lectures, we can review this. We can see what this market did, and we're going to talk about it so that we can build perspective. Anyway, fantastic guys. Thank you very much for turning up for another lecture. I hope this is seriously impacting you. And if you need to get hold of the profile, you need to get hold of it. Right, talk to me about it. It'd be far cheaper for you if you get it from me than if you get it elsewhere. I'm just telling you the reality of it. And if you don't believe me, search around and see what you can find. Other than that, happy to make it available to you. Just let me know. Till the next lecture, guys. Adios.